It is 5 a.m. in New York City. Good morning. I'm Matt Miller in for Vonnie Quinn with your Bloomberg Brief. Here's what you need to know. Data catch-up. Stocks fall as investors await the release of the November payrolls data. The whisper number is only 21,000 jobs were added last month. And closer than ever, President Trump shows optimism in ending the war on Ukraine. President Zelensky says the U.S. has vowed a congressional vote for security guarantees. And softening the rules, the EU is set to propose scrapping a ban on combustion engines for new cars after months of pressure from the autos industry as well as consumers. Let's take a look at what's going on in terms of the markets right now. The S&P 500 futures are down about 0.5%. We fell again in yesterday's session, and the close were just above 6,800. Nasdaq futures down more, about 2/3%. The small caps down 0.5%. Take a look at what's going on with treasuries. Not a lot of movement there. You can see the 10-year yield almost exactly unchanged at 4.1704. The 2-year trading at just under 350, and the 30-year at 485. In terms of commodities, we're watching the oils this morning. New York crude is down 1.8%, $55.78 a barrel on the NYMEX. Brent crude down just about the same at $59.55, so just under $60 a barrel, and Bitcoin at 86,305. Let's get a look at some of the individual stock stories for the stocks you need to watch. Let's bring in Valerie Teitel from London. Good morning, Valerie.
Good morning, Matt. Let's start with a check on Ford after announcing that near $20 billion charge in a sweeping unwind of its EV program. We're seeing shares of Ford up around 0.4%, so outperforming the broader market by near 1% off the back of this. Ford is going to be reassessing how it's using these battery plants and pivoting a bit more towards hybrid vehicles and away from these larger format EVs, and also announced a essentially scrapping of their Ford F-150 electric vehicle model. Ford does expect their EV platform now to be profitable in 2029, and it boosted its 2026 guidance off the back of this. So Ford enjoying somewhat of a jubilant reaction to this $20 billion charge. Next, let's move over to the streaming platform Roku. Matt, there's been a lot of excitement in this stock recently. It got more excited overnight by a upgrade from Morgan Stanley. The share is up 4.3% in pre-market trade. Morgan Stanley previously had concerns around competition, but those are no longer. They see its dominant place in the streaming services in the U.S. is going to give it a key edge in the market next year. Lastly, I do want to touch on European defense. We're seeing a big slide across the sector in Europe this morning. Rheinmetall down 4.5%. This comes after more positive comments for a move for peace in the Russia-Ukraine war. Now, defense stocks have been on a back foot since their highs back in September. Rheinmetall is down around 25% since those year-to-date highs at the end of September. But note, Matt, it's still up around 140% year-to-date, and defense stocks rank among many of the top 10 performers across Europe still for 2025. Matt?
All right, Valerie, thanks very much. Valerie Teitel there with some of your pre-market movers. Coming up in this hour, we're going to count down to the jobs report with Henry Allen. He'll join us as macro strategist from Deutsche Bank. That's at 5:30 a.m. New York time. Back to our top story, though. President Trump staying optimistic on reaching the end of the Russia-Ukraine war.
I think we're closer now, and they will tell you that they're closer now. We had numerous conversations with President Putin of Russia, and I think we're closer now than we have been ever.
President Zelensky now says he has an agreement with the U.S. to make security guarantees through a congressional vote as part of this deal. Joining us now is Bloomberg's Oliver Crook. So, Oliver, how optimistic are people on the European side?
I think they're very sort of encouraged by what they've heard from the President of the United States and the talks that we've had for the last 2 days that have been held in Berlin with Steve Witkoff, Jared Kushner, and a number of European leaders who were also in attendance. And it all comes down to this idea of U.S.-backed security guarantees. From the Ukrainian perspective, they're absolutely essential to any kind of peace deal, because what is a peace deal worth, really, if you're going to get reinvaded in 2 or 3 to 5 years' time? These security agreements, particularly backed by the United States, are seen as a way to really prevent that from happening. Now, What they actually include is less clear. These Article 5-like guarantees, no one has yet defined what Article 5-like means, other than the Article 5 within the NATO treaty, which means an attack on one is an attack on all. So it basically would create a security architecture that if Ukraine were ever to be reinvaded, there would be some degree of backing from the NATO architecture, from the United States, unlikely to be boots on the ground from the U.S., but it would mean that there is actually a formula and a recipe in place if ever there was renewed conflict within Ukraine. That being said, that is progress on the sort of security guarantee side. There's still the territorial side, which has got to be still the thorniest issue. The Russians have said from the very beginning they don't even want to talk about a ceasefire or get a temporary ceasefire in place until there is a settlement with the rest of the Donbass resting with the Russians. That is something that the Ukrainians have not yet agreed to, though they have shown a little bit of movement in that direction. That being said, it'll be up to the United States to try to square that circle and sending this proposal back to the Russians, from whom we have not yet heard on what they have to say about what the Europeans and the U.S. have come up with.
It does seem that the Ukrainians are backing down on a number of different issues, and surely President Zelensky wants to end this war. But has Russia given up any ground in these months of negotiations?
I mean, not so far that we have seen. I mean, this is the main point here. I mean, in the last couple of weeks, though, Matt, we should say that this is something that the U.S. administration and Trump has not really advertised a great deal. But there are those significant sanctions that were put in place a couple of weeks ago, both on Rosneft and Lukoil. This is a sort of major way to constrain some of the revenue that the Russians are still taking in and getting paid for in order to sort of fund this war. From the American perspective, I think at a certain point, again, Trump has really been focused on targeting the Ukrainians as the sort of weak point in the negotiation, and they've put up a lot of pressure there. There is still possible pressure they could exert on the Russians if they feel the Russians are being unreasonable. At the moment, we still have pretty maximalist demands from the Russians. We have not yet had a confrontation between the U.S. and the Russians, but as you'll remember, sitting with Congress right now, waiting for the go-ahead from President Trump, are those so-called bone-crushing sanctions that Lindsey Graham has put forward. That has wide bipartisan support within the United States. If they wanted to move on that, that would put tariffs basically on any country that is buying Russian crude oil. That could have a major effect, and that could drive them to the table if the United States wants to pull that trigger.
All right, Oliver, thanks very much. Oliver Crook there joining us live from Brussels on this optimism in the Russia-Ukraine war. Now, the Nasdaq is asking the SEC for permission to extend its trading hours to 23 hours on weekdays. The exchange joins its peers as demand grows for U.S. stocks outside of traditional market hours. Joining us now is Bloomberg's Justina Lee. Justina, let me ask first what this would look like. Surely it wouldn't be, a cash session for 23 hours. Is it an extended pre-market and aftermarket that the Nasdaq wants to put into place?
Yeah, Nasdaq has kind of gone to the SEC to apply for kind of adding this session that will be kind of coming after the aftermarket session, sort of like an aftermarket session, I guess. So it will kind of like go from 9 p.m. Eastern to 4 a.m. Eastern the following day, taking the trading hours to 23 hours a day. And of course, this is coming after the New York Stock Exchange is also making similar moves to extend trading hours to 22 hours for every weekday.
So is there really that much demand to trade on those hours? Are we going to see, volumes boosted as a result of this?
I think that really is the big question here. Now, for a few years, we've seen a push in this direction, partly because of, I think, a lot of retail investors getting used to the 24/7 schedule of crypto trading. And of course, there's also a lot of interest in trading U.S. stocks, outside of the U.S. And so I think for, a trade in Australia or something, they might kind of welcome a bit more overlap with their working hours. But, I think there's still kind of a big question. When I talk to a lot of traders, you hear nothing but groans about this plan. I think a lot of people like having that break at 9 p.m. Eastern, some time to digest, 4 p.m. Eastern, some time to digest, the aftermarket news. And of course, if you don't get enough volumes in these after hours, you might actually get a lot of price swings that don't really mean anything because there isn't enough liquidity. And so I think a lot of people still have kind of a lot of doubt over this plan.
All right, Justina, thanks very much. This is something I'm sure we'll be talking with you about more and more. Justina Lee there out of London on the Nasdaq request to extend trading hours. Let's get to the other top stories trending on the terminal this morning. President Trump is suing the BBC for $10 billion over a misleading edit in a documentary last year. The clip gave the impression he had made a direct call for violence in a speech leading up to the January 6, 2021 attack on the Capitol. The BBC previously apologized for the edit, but Trump deemed the apology inadequate and now is seeking massive amounts of compensation. China's Xi Jinping is facing calls for a stronger yuan in a rare public currency debate. Chinese economists and former central bank officials are arguing a stronger currency is needed to rebalance the economy away from exports and boost consumer demand. The calls are fueling speculation. Policymakers will allow broader appreciation in the managed currency. And UK unemployment climbed to its highest level in almost 5 years. Wage growth eased, cementing the case for a widely expected Bank of England rate cut on Thursday. The jobless rate rose to 5.1% in the 3 months through October. Wage growth, excluding bonuses, edged down to 4.6% from 4.7%. Of course, we'll get our own jobs numbers today here in New York. Coming up, a win for car makers. The EU waters down its effective ban on sales of new combustion engine cars from 2035. More on that next. This is Bloomberg. This is Bloomberg Brief. I'm Matt Miller in New York City. European automakers are rising, as with the exception of BMW, I guess, as the EU is set to propose easing emissions rules for new cars, which would abandon an effective ban on combustion engines following months of pressure from the industry, and I've got to imagine some consumers as well. Bloomberg's Eric Fanner joins us for more. So, Eric, what do we know about the rules as it stood? I think 100% tailpipe emissions reductions were demanded by 2035, and now that'll just change about 10%.
Yeah, that's right. I mean, that's how it looks on the surface. This was quite a rigid ban. In effect, would have ruled out sales of combustion engines after 2035. So there wasn't a whole lot of wiggle room there. What they've done now is it looks like they will introduce some wiggle room there and reduce the emissions targets to 90% reduction. Now that sounds kind of incremental on the surface, but is actually a lot more sweeping than it sounds potentially, in part because the emissions targets for hybrid vehicles are often a lot higher in theory than they are actually in practice. So if they stick with those kind of theoretical emissions for the hybrid vehicles, you could actually see a pretty high continued sale of hybrids, making up a big portion of the automakers' mix down the road beyond 2035.
Eric, yesterday we got news from Ford. They're going to take almost $20 billion in charges tied to a pivot away from essentially the same story, right? 100% BEV to hybrids and what are called E-revs, which is essentially an electric vehicle with a gas generator on board. Is this the trend that every place is going? Because we're talking about the EU specifically, but here in the U.S. we're also going to see much more lax regulation.
Yeah, exactly, Matt. It's a global thing, really, or at least a broader thing beyond China, which has had pretty broad EV adoption. Although even there in China, there's a growing use of what you mentioned, the range extenders, which are the small gas-powered engines that help fuel an EV and extend the range. So we're seeing this really globally. We've had a bunch of car makers, and Ford is the latest and one of the most dramatic announcements, announcing a big write-down there, $19.5 billion, and canceling some models, switching over some plants to back away from battery electric vehicle production. So it's a broader thing. Consumers are not taking up EVs as quickly as hoped. That's obviously a transatlantic trend, and certainly not without incentives. And the incentives just aren't forthcoming necessarily the way they were, either in the U.S. or the EU, across Europe. And so we're seeing that kind of broader pullback.
All right, Eric, thanks very much. Bloomberg's Eric Fanner talking to us about the EU regulation story. And as we were talking about, of course, there was the Ford news yesterday, one of the biggest write-downs in automotive history. We spoke with the CEO of Ford, Jim Farley, yesterday on the overhaul of the car maker's electric vehicle business after it struggled to make a profit for years. Take a listen.
We saw hybrids really take off the last couple of years, like, last month we had a 30% increase in our hybrid sales. We're now number 3 I think we're 80% hybrid market share in trucks. So we saw this happening. We also saw the more expensive EVs, really suffer in the market, and the more affordable EVs to do better. And then the last couple months really was remarkable. The EV market in the U.S. went from 12% in the industry to only 5%. And that really, in the end, was the big decider for us. But look, we're going to 50% electric. It's going to be hybrids and E-revs and electric. It won't be just pure electrics.
So, every good trader knows you got to cut your losses when you recognize there's an issue. You're doing that in this sense with the F-150 Lightning as we now know it, and the T3 project, the next generation truck that would have been built in Tennessee. But you're able to, I guess, salvage some assets, and as a result, you've raised your profitability forecast from $6 to $6.5 billion for this year in terms of EBIT to $7 billion. Where are you gaining an opportunity from this, Jim?
Well, great question. This year, in the short term, it's really our cost of our company. Our quality is getting better, and so our costs are much more competitive. In fact, the Novelis aluminum has cost us more like $2 billion, but we're still raising guidance. Look, for this announcement, Matt, it's really about moving to more profitable vehicles. We're going to make in Tennessee now an affordable pickup truck. I think it's going to really surprise the market. These are customers we know. Not a lot of guesswork in terms of the revenue, the cost we need to get at, and a more affordable van in Ohio. So these are going to be better investments for the company profit. And all those hybrid sales, those are really profitable vehicles for us as we basically deploy hybrid across our lineup. But we're also going into the energy storage business to 20 gigawatt hour. That's a big move. We're going to convert our battery plants from automotive batteries to energy storage batteries using LFP. That's also a big pivot that is profit positive for the company.
Jim, with regard to that pivot and the energy storage side of it, do you anticipate any concerns by the White House, by the administration here in the U.S., that you are partnering effectively with the Chinese company in order to do that?
Mm-hmm. Well, look, it's our plant, it's our people, and we designed it that way. We have a licensing agreement, but we feel like it's better to build these batteries in the United States with American workers, with our own Ford workers, and understand the IP than to import them like they're being done today. The best way to compete with the Chinese is to get close to the IP and then run the plants at Ford. When Ford knows how to build things, we know how to do this. So I think this is much better than for America. We're talking about thousands of incremental jobs versus importing batteries like we say today. Much better for America.
And that was Ford CEO Jim Farley speaking with Romaine Bostick and myself. Coming up, an overhaul at the Pentagon. Secretary Hegseth's team reportedly planning major power shifts. And a look at what else is making headlines in your front page news next. This is Bloomberg. This is Bloomberg Brief. I'm Matt Miller in New York. Time now for your front page news. First up on the Washington Post. Sources say senior Pentagon officials are developing a plan to downgrade several of the U.S. military headquarters and shift the balance of power among top generals. The plan would include cutting the number of four-star generals and admirals reporting directly to Secretary Hegseth. The move would complement other efforts by the administration to move resources away from the Middle East and Europe. Secretary Hegseth's team declined to comment. Next up, the Wall Street Journal reports that CoreWeave's $33 billion fall highlights AI bubble fears. Its problem began with a low-tech challenge, summer rainstorms in North Texas that delayed construction of a major AI data center. That data center is meant to be leased to OpenAI. And on the Financial Times, companies are looking for private equity partners to save their business in China. Companies like Häagen-Dazs, Peet's Coffee, and GE Healthcare are weighing options such as selling part or all of their China operations. The rethink comes from the rocky relationship with the U.S., a slowing economy, and a rise in local rivals. In terms of the markets, we are looking at futures that are down ahead of the non-farm payrolls report coming out at 8:30. The delayed report from November, S&P futures off 0.33%. The dollar really little changed, as is the 10-year yield at 4.1743. Coming up, we'll push ahead to the payrolls report with Henry Allen of Deutsche Bank. This is Bloomberg. It is 5:30 a.m. in New York City. Good morning. I'm Matt Miller in for Vonnie Quinn with your Bloomberg Brief. Here's what you need to know. We'll get a data catch-up today. Stocks are down as investors await the release of the November payrolls data, the delayed data. The whisper number is for only 21,000 jobs added last month. And we're closer than ever. Well, at least President Trump is showing optimism in ending the war in Ukraine. President Zelenskyy says the U.S. has vowed a congressional vote on security guarantees. Plus, the ever-softening rules. The EU is set to propose scrapping a ban on combustion engines for new cars after months of pressure from the autos industry and I imagine at least some consumers as well. Take a look at what's going on in futures this morning after a drop yesterday, an even bigger drop on Friday. We're down again today with S&P futures off about 0.3%, Nasdaq futures about 0.4. In terms of treasuries, there's very little change, at least on the 10-year, still looking at 417.43, so not even up a quarter of a basis point there. And we do have oil falling this morning after a drop in Bitcoin as well. So NYMEX crude down 1.7%, Brent about the same, and Bitcoin had come down, now bouncing back a little bit, but still at 86,378. I don't know why I'm tying the two together. They're just both in the same board here. For some of the stocks to watch, let's get out to Valerie Teitel in London. Valerie?
Good morning, Matt. Let's start with a check on Ford announcing that near $20 billion charge related to a sweeping unwind of its EV program. We're seeing shares of Ford in the green, up around 0.4%, so outperforming the broader market by around 1% on this announcement, which essentially is really saying to the market that they were going down a dead end with these large format EVs. They have totally scrapped now their electric Ford F-150s and are pivoting the business closer or towards more hybrid vehicles. Gas and hybrid vehicles will be their new focus. Now, off the back of this, they did say that their EV business will be profitable by 2029, and they did raise their near-term guidance for this year. So Ford slightly in the green off the back of this announcement. Let's move over to the streaming market. A lot of excitement about this stock, Matt. It's Roku. They've gotten a lot of upgrades from the street recently. The latest one now coming overnight from Morgan Stanley. We're seeing shares of Roku up 4.5%. Morgan Stanley was previously concerned about competition among these streaming platforms, but they are no longer concerned about that and are excited about their dominant position within the U.S. market and what that means for their possible advertising revenue next year. Lastly, I do want to touch on European defense. A big slide across the European market today. Rheinmetall in the red, down 4.6% on a back foot as there's more positive comments for peace in the Russia-Ukraine war. But these defense stocks have really been battered in the fourth quarter. Rheinmetall is down some 25% since the end of September, but alas, it is up 140% year to date. And many of these European defense companies rank among Europe's top performers for 2025.
All right, Valerie, thanks very much. Valerie Teitel there looking at some of the individual movers ahead of the cash trade. Less than 3 hours to go until the release of the delayed November jobs report. Bloomberg's Michael McKee joins us here on set, our international policy and economics correspondent. Mike, what are we expecting? I pointed out the whisper number is quite low, but the survey is a little bit higher.
And neither one of them really has a lot of grounding in fact at this point, because we don't even have the October numbers, which we'll get part of today. And that's part of the problem, is we get 2 months wrapped into one, and I could bore the pants off you and talk about the statistical problems with trying to put this together. But let's just say the Labor Department has already suggested that the error bands are going to be wide around these numbers, wider than usual. It's going to be hard to know exactly what they are telling us. We will get the average, we will get the payrolls numbers for October and November, but we don't really know what October is going to give us, because we don't know how much data they got. We'll get average hourly earnings, but we're going to only get the unemployment rate for November. And the unemployment rate is expected to tick up, but that's based on what? We don't know. It went up in September, but what happened in October? There's no data, so we don't have an idea. Same story with average hourly earnings, and the same story with overall payrolls and whisper numbers and everything like that. It's just going to take a little while to figure all this out.
So, you know, historically, 4.5% is the estimate for the unemployment rate, and that's a fairly low number historically, although it's getting to a lot for, you know, kids today. At what point does the Fed really start to worry, or what point do policymakers really start to worry about U.S. unemployment?
Well, that's a good question, because they had been saying into the summer that they would start worrying if we moved quickly to 4.5%. Now, we've moved to 4.5%, if these numbers are correct, but how quickly has it been, and why did we? Because more people came into the labor force, or because fewer people got jobs? Those are the questions that are not answered, and they haven't really given us an answer in terms of a number, but they have said that what they're worried about is that unemployment could start accelerating, and that's why they have been cutting rates. So we'll get some idea of where we are, but we don't know where we're going.
We are getting, we're getting a ton of, more than a full Bloomberg screen of data today. What else are you going to be paying close attention to? I guess we've got retail sales coming out. We've got some PMIs coming out.
Well, retail sales will get some attention because we haven't gotten that either since the September numbers, and they are expected on a headline basis to slow. The core is expected to rise some from the September numbers. But remember, retail sales are always heavily revised, and so we don't have a lot of basis for this either because we don't know what October was. We'll get those numbers, but this is also in between back to school time and Black Friday, Thanksgiving, the kickoff to the holiday season. So I'm not sure how much relevance they will have other than filling a hole. Maybe the S&Ps, because they are not government data. They have been released every month, and they'll tell us something about where we are with manufacturing and service industries.
All right, Mike, we're going to continue speaking with you as this data comes out. Michael McKee, our international policy and economics correspondent. Now, joining us to talk about what to expect and how the Fed may deal with that, Henry Allen, macro strategist at Deutsche Bank. And before I get your take on the numbers we're looking at, just give me generally your take on the U.S. economy and how the labor market looks with all of the other data that the alternative data that we've been following more closely of late.
So I think, as you've just alluded to in your conversation, the labour market is certainly showing signs of weakening, and I think that this payrolls report is definitely going to be a very, very choppy one. So we're going to have to abstract and stand out from some of the data, given that it's going to be so choppy following the government shutdown. But I think in terms of the US economy more broadly, there's actually a story of big resilience. If you told us at the start of the year that we'd have the huge tariff shock that we did, yet risk assets would do really well and the economy would keep growing at a decent clip, that would have been seen as remarkable. But to be honest, that just continues the trend we've seen over recent years, where similarly in 22-23, the US economy weathered the fastest rate hikes in a generation really, really well. The soft landing was achieved. And I think that speaks to a broader resilience that even as we are seeing some signs of labour market weakness, that actually the big picture story of the US economy remains a very strong one.
So I wonder if these cuts that we've seen so far, I think since last November, 125 basis points for the Fed, is that really going to help slow down the weakness in the U.S. labor market?
I think that will certainly help. And indeed, of course, that's why the Fed have been so quick to react. Even if you just look at the last 6 weeks, it's worth bearing in mind that at the time they did the October cut, the second cut this year, Powell was saying at the press conference that a December cut was not a foregone conclusion. Yet we then had the delayed September jobs report. That came in weaker than expected. Unemployment ticked up. And then suddenly a cut was priced back in for December, which they then delivered. So this is a Fed that, even with inflation above target thanks to the tariffs, are still very, very sensitive to any signs of labour market weakness, and hence they're going to be stepping in. And then I think the other thing that will certainly be supportive looking into 2026 is actually, alongside this monetary stimulus, we've also got pretty big fiscal stimulus. So as well as the mechanical bounce back from the shutdown, we've also got lots of the big, beautiful bill taking effect in Q1 2026. And actually Q1 next year is going to be one of the biggest positive fiscal impulses we've seen since the pandemic stimulus under Joe Biden. So actually there are a lot of positive tailwinds going to hit the economy next year.
Well, I mean, I wonder if that worries you at all, Henry. We've got monetary stimulus. We've got fiscal stimulus. We've got the tariffs. I mean, tie these things together with inflation already 50% above the Fed's target rate. Is there any way that it cools down inflation, or do you see it actually picking up in 26?
Well, I think that's the risk and where markets could be caught offside, because if we look at even the last couple of weeks, US inflation swaps have trended down quite a bit, and obviously that opens up the risk that the surprise goes the other way. As you say, tariffs are still filtering through. We have monetary and fiscal stimulus, which is, not unprecedented, but is particularly unusual that we're getting that outside of a recession. Normally when we get kind of rate cuts, we've had 175 bips in the last 15 months. Normally when we're getting big fiscal stimulus as well, that's happening in a recession. So it's an unusual framework, an unusual regime that we're getting that in a soft landing where the economy is seeing continuous growth. And that's where I think there's a need to be cautious about any reacceleration or overheating, because when we have seen that dual monetary and fiscal stimulus outside a recession, we saw it in the US in the mid to late 1960s, actually the risk is that then sets the stage for inflation to accelerate. So that's really going to be something I think the Fed are going to have to be very cautious of. And indeed, I think a lot of speakers are, which is why you're seeing growing numbers of dissents on the hawkish side.
By the way, we got, some news on Ford yesterday, which to me was exciting because I love, the world of automakers. But it strikes me that, tied together with what we're hearing from the EU, we have loosening regulations really globally. And policymakers with that are trying to support growth, which is understandable. But as you point out, we're not in a recession. Is this just another piece of policy that risks, supporting growth, but also stoking the kind of inflation that is going to require slamming on the brakes later?
Well, I think we should distinguish when we talk about change in regulation or changes in fiscal monetary policy. We should distinguish between demand-side policies and supply-side policies. Clearly, if we've got demand-side stimulus like rate cuts or tax cuts, then clearly that's the sort of thing that will lead to overheating. If we can get deregulation that opens up support on the supply side, then actually that sort of thing, as we're seeing also with the AI productivity increases, and that sort of thing that can help the economy grow faster in a non-inflationary way. I mean, the idea would be a bit like what happened in the mid to late 90s, where Alan Greenspan was able to cut rates successfully, even as the economy was running at a decent clip, because we had such positive growth on the supply side as well as the demand side. So that's the holy grail, really. I guess the question is, is that demand side stimulus that we're seeing, which is historically pretty unusual to see that much outside a recession that we're going to get next year, is that going to help? And the problem is that isn't just a US story. We're focusing on the US, of course, but here in Europe, we've also had the ECB cut by 200 bips between mid-24 and mid-25. Next year is going to be the year that the German fiscal stimulus takes effect. That's more than going to outweigh any tightening we get in France and Italy. So Europe's also seeing that dual combination of monetary plus fiscal stimulus. So I think this is really going to be a global story into next year.
Henry, great to get some time with you. Really fascinating comments. Henry Allen there joining us from Deutsche Bank on the macro picture ahead of the jobs numbers. Let's get to some of the other stories trending on the terminal this morning. Australian authorities say homemade Islamic State flags were found in a vehicle registered to one of the gunmen that attacked a Bondi Beach Hanukkah celebration on Sunday. At least 15 people were killed in the terror attack. As more details on the father and son gunmen emerge, officials in Manila say the pair traveled last month to an area of the Philippines where Islamic State-aligned groups have operated. Amazon is expected to cut jobs in its European headquarters in Luxembourg. The cuts represent about 8.5% of its workforce there. The layoffs are particularly challenging for foreign employees who must find new jobs in 3 months to continue living in Luxembourg. And the European Union is set to propose softening emissions rules for new cars, scrapping an effective ban on combustion engines. As I was just talking about with Henry, the proposal will allow car makers to slow down the rollout of 100% battery electric vehicles in Europe, though they'll be selling hybrids and e-revs. This follows months of pressure from the auto industry on the EU. Coming up, Ukraine peace talks ongoing. President Zelensky says the U.S. has vowed a congressional vote to back security guarantees. More on that next. This is Bloomberg.
I think we're closer now, and they will tell you that they're closer now. We had numerous conversations with President Putin of Russia, and I think we're closer now than we have been ever.
Washington offering Article 5-like security guarantees to Kiev. Reportedly, President Zelensky says the U.S. has pledged a congressional vote to make it legally binding. Let's bring in Mika Solner of Bloomberg Government. Mika, it's interesting that the U.S. would make a pledge like that because obviously we can't know what Congress will do. How does this all work out?
Yeah, absolutely. This is, an initial step, I think, for the U.S. to really take into these considerations for Ukraine. I know that President Trump has been really adamant that the U.S. is really focused on both sides, both what Russia and Ukraine want. So this would be a significant step for Ukraine. This would essentially ensure those protections are codified through Congress. And a lot of members of Congress, Democrats especially, but a lot of the Republican conference, despite some voices that have said that they don't want to aid Ukraine anymore in this war effort, are still highly supportive of Ukraine and the war, ending this war effort.
All right. So what would this entail? And when are we going to find out more details? Because so far we're relying on really just President Trump's optimism and President Zelensky's reporting.
Yeah, I would say that President Zelensky has been very outspoken in terms of the process of these negotiations. The White House has been a little bit less transparent in them. I think that they're still working out a lot of details, which continue to be fluid. And I think that's one thing the White House doesn't really want to get ahead of themselves when it comes to negotiating this very difficult and complex peace deal that the U.S. is handling with European allies. And, I think that we're going to see more in the coming weeks. The administration has had a really hefty timeline on this. Initially, it was supposed to be Thanksgiving Day. They wanted this to be all worked out. So I think we're going to trickle into the new year potentially.
Let's talk about healthcare for a moment. Affordability has been really the mantra of Democrats and picked up essentially by Republicans. But is either one of them going to be able to solve this crisis as we see Obamacare premiums skyrocket?
Yeah, Matt, time is really running out here. We only have a few more weeks. I think Congress actually is only in session for about another week before they all leave for the holiday break. But House Republicans have a bill that they're going to try and put up on the floor this week, but that does not include the ACA subsidies extension. So that can definitely be amended in a way. I know that there are moderate Republicans who are very adamant on this issue that want to include that in this bill. But as of right now, we're not seeing that. We're going to have to see what happens this week. The Rules Committee is set to meet on this, and then we're going to potentially see a vote later this week.
All right, Mika, thanks so much for joining us. Mika Solner there out of Washington, D.C. from Bloomberg Government. Now, the Nasdaq is asking for approval from the SEC to add an extra session from 9 p.m. to 4 a.m. Eastern Time, making the trading day 24 hours long during the week. Bloomberg's Justina Lee joins us from London. And Justina, why exactly do they want to do this? Some of us need a rest.
I know, right? I think we've kind of seen a push in this direction for a while. The New York Stock Exchange has been planning a similar extension. I think one factor is, retail investors, they're already used to trading 24/7 on Robinhood and, on crypto exchanges. And another factor that, the Nasdaq statement pointed to is kind of global investors who kind of really want to be able to trade U.S. stocks, even outside of the regular trading hours, with more overlap with kind of a lot of overseas investors' working hours. And so I think these two factors are really kind of intersecting here for this push for, kind of close to 24-hour trading on workdays.
So how would this look? I mean, it's not going to be a 23-hour cash trade. It would just extend, what, the after-hours session?
Yeah, so the Nasdaq has gone to the SEC to ask for permission to add a session that's coming after, the after market hours. And, we kind of still need to untangle kind of a few operational issues, with the clearing and also with the data feeds and all that. And I think, the question here really is how much liquidity are we going to see in this kind of newly added session? Because if the liquidity is not that strong, it could be that we're kind of just going to get a lot of swings that won't really mean a lot to many investors.
All right, so we could, I guess we're inevitably going this direction. Are those swings really a concern? Because this could be low volume trading, and then we're going to be reporting on massive moves that don't really mean as much.
Right, exactly. I think that's a lot of people's concern right now. I mean, one thing that I find interesting is that if you actually look at what's happening during the regular trading hours right now, there's been an increasing percentage that's just happening, in the closing auction. So if anything, among a lot of institutional investors, they actually kind of increasingly just want to trade in those couple of minutes near the close. A lot of that is because of passive. And so I think there's a lot of question as to how much demand there really is among kind of a lot of professional traders, or whether really this is just a retail driven push.
All right, Justina, thanks very much. Bloomberg's Justina Lee talking to us about this NASDAQ story, asking the SEC to extend trading hours to 23 a day. Coming up, payrolls report on deck. In your day ahead next, this is Bloomberg. This is Bloomberg Brief. I'm Matt Miller in New York. Let's take a look at what's ahead today, because there is a lot. Starting with the main event, delayed November jobs report out at 8:30 a.m. Eastern. We're going to be combing through that. Also, we're getting retail sales data that was delayed at 8:30 as well. Following that, we'll get manufacturing and services PMIs at 9:45. In terms of the stocks that we're watching, Intel, Samsung's foundry division, Intel and Samsung's foundry division, I guess, are close to beginning mass production of Intel's platform controller hub chips. That's according to Korea Economic Daily. Roku has been raised to an overweight at Morgan Stanley, with the price target at $135, following an upgrade from Jefferies and a lifted price target from Wedbush last week. And Accenture upgraded to overweight at Morgan Stanley, which cites compelling valuation following this year's pullback in the shares. A price target there of $320. Taking a look at futures ahead of right now, about 4 hours ahead of the opening bell, 3.5. S&P futures down 0.3%. The dollar and the 10-year yield little change, but oil down 1.7. That's it for the Bloomberg Brief. Surveillance is next.